Hello and very good day everyone. We are from Group2 and the company that we're going to present is Greatech Technology Berhad. And these are our group members.
Greatech Technology Berhad, founded in 1997 in Penang, Malaysia, is an experienced factory automation solution provider. It serves diverse industries such as renewable energy, semiconductors, life science, and electric vehicles, reducing industry risk. So the company has shown consistent revenue growth over the past 5 years, supported by strong demand, a solid order book, and global expansion. Despite cost and currency pressure, Greatech maintains stable profitability, reflecting strong cost management and growth potential. So next, I will explain about the company's liquidity performance over the past 5 years. So overall, the company maintained a strong liquidity position from 2020 to 2024. The current ratio remained above 1 throughout the period, indicating that the company was able to meet its short-term obligation. Although it declined in 2022, it improved significantly in 2024, showing stronger working capital management. The quick ratio also stayed above 1 in all years, which means that the company could settle current liabilities without relying on inventory. This reflects good short-term financial flexibility. However, the cash ratio showed some weakness in 2022 and 2023, suggesting that lower intermediate cash availability. This situation improved in 2024 as cash holding increased. So in a conclusion, despite temporary liquid pressure in the middle years, the company liquidity position strengthened in 2024, indicating improved short-term financial stability.
Over the 5-year period from 2020 to 2024, the operational efficiency of Greatech can be said to vary significantly or go through distinct phases. Inventory turnover improved in 2021, indicating more efficient inventory management. However, from 2022 to 2024, inventory turnover declined, suggesting slower movement of inventory. This trend is consistent with the average age of inventory, which decreased in 2021 but increased steadily afterwards, meaning inventory took longer to be sold in later years. In terms of receivables management, the average collection period increased from 2020 to 2021, indicating slower customer payments. It then improved in 2022, showing faster collections, remained relatively better in 2023, but worsened again in 2024, reflecting inconsistency in credit control. Meanwhile, the average payment period declined in 2021, increased from 2022 to 2023, suggesting greater reliance on supplier credit to support operations, before falling again in 2024 as the company improved its ability to settle obligations. Looking at asset utilization, total asset turnover increased in 2021, dropped sharply in 2022 due to heavy capital investment or project delays, and then recovered strongly in 2023 and 2024, indicating improved efficiency in using assets to generate revenue.
The leverage ratios of Greatech Technology Berhad from 2020 to 2024 show some fluctuations. The debt ratio declined from 2020 to 2021, grew slightly in 2022, and then fell again by 2024, indicating the company relied less on debt overall. Similarly, the debt-to-equity ratio dropped in 2021, rose slightly in 2022, and declined again through 2024, reflecting either debt reduction or strong equity growth. The equity multiplier followed the same pattern with a slight increase in 2022, likely due to a short-term borrowing or asset investment. The times interest earn ratio improved significantly in 2021 and remained high until 2024, when it dropped due to rising interest from these liabilities. Cash coverage grew steadily from 2020 to 2023, boosted by higher operating revenue and better cash management. In 2024, depreciation increased sharply because of heavy investment in new and leased assets. Overall, Greatech has maintained strong financial stability with manageable debt levels despite some temporary changes in financing and asset investment. The profitability ratios of Greatech Technology Berhad from 2020 to 2024 show some declines. EPS dropped from 14 cents to 0.062 cents, reflecting changes in net income trends despite overall value generations for shareholders. The gross profit ratio fell slightly from 0.43 to 0.42, suggesting production costs are rising faster than revenue, partly due to global supply chain disruptions. The operating profit margin declined from 0.37 to 0.27, showing operating costs grew faster than revenue, while the net profit margin decreased slightly from 0.24 to 0.23. ROA stayed steady at 0.15, indicating consistent efficiency in using assets, but ROE fell from 0.33 to 0.21, reflecting lower efficiency in converting equity into profit. In summary, most profitability ratios show slight declines, but EPS growth doubled, supported by increased net income and strong orders in e-mobility, life sciences, and solar industry.
Moving on to market ratios, the market-to-book ratio peaked in 2021, reflecting strong investor confidence, declined in 2022 and 2023 due to weaker sentiment, and rebounded in 2024, signaling renewed optimism. Similarly, the price-to-earnings ratio rose sharply in 2021, stabilized at lower levels in 2022 and 2023, and increased again in 2024, indicating improved growth expectations.
Hello guys, this is Taiyuan, and now let's talk about the cost of capital evaluation. First, the cost of debt is calculated by dividing finance cost by average borrowings. For 2024, Greatech's pre-tax cost of debt is approximately 7.45%, and after adjusting for tax, the after-tax cost of debt is about 6.43%. Although this rate appears moderate, the company carries very low levels of debt and operates in a net cash position, meaning debt has only a small influence on overall capital cost and financial risk. Next, the cost of equity is estimated using the capital asset pricing model, which is CAPM. The risk-free rate is based on the Malaysian 10-year government bond, while the expected market return reflects long-term Bursa Malaysia performance. Given Greatech's exposure to cyclical automation industries and its low leverage, a beta of 1.2 is viewed to reflect business risk rather than financial risk. This results in a cost of equity of approximately 11.24%. Next, Greatech's capital structure is heavily equity-based, with equity accounting for over 98% of total capital. As a result, the firm's weighted average cost of capital is approximately 11.17%, which is very close to its cost of equity. This suggests that the firm is not optimizing its capital structure from a theoretical perspective, but instead prioritizes financial stability and flexibility. And the security market line visually represents the CAPM relationship between risk and return. Greatech's expected return based on its beta of 1.2 less close to the security market line. This indicates that the return required by investors is consistent with the firm's level of systematic risk, suggesting no clear mispricing under the CAPM framework. And finally, based on the CAPM and SML analysis, Greatech's equity appears to be fairly valued, as investors are adequately compensated for the firm's systematic risk. In addition, the company's debt securities are conservatively priced due to very low leverage and minimal default risk. For investors, this implies stable and risk-adjusted returns that are driven mainly by operational performance rather than financial leverage, making the firm attractive to long-term and risk-averse investors. And that's all for my part. Thank you.
Our investment recommendation for Greatech Technology Berhad is hold. The company is financially very strong, but its recent efficiency and valuation trend suggests limited upside in the near term. First, Greatech liquidity and solvency are excellent. In 2024, the current ratio is 3.59 and the quick ratio is 3.19, showing it can easily meet short-term obligations. Leverage is very low with a debt ratio of 0.18 and debt to equity of 0.22, while the time interest earned is 177 times, meaning very low financial risk. However, profitability efficiency has weakened. ROE fell from 33% to 17%, and operating profit margin declined from 40% to 26% due to rising operating and depreciation costs. Inventory turnover also dropped with stock held for about 49 days. The stock also looks expensive with a PE of 37 times and market to book of 6.35 despite declining performance. Therefore, although Greatech is financially stable, we recommend investors to hold and wait for better performance or a better entry price.
My name is Emily, and lastly, I'll be continuing with the conclusion of our analysis. So overall, Greatech Technology Berhad demonstrates strong financial health and stability throughout the 5-year period. Despite the sharp decline in 2022, the company maintained solid liquidity with effective working capital management and strong cash reserves, with their current, quick, and cash ratios in acceptable ranges, allowing it to meet short-term obligations effectively. The company also demonstrated low financial risk levels, having its debt levels and debt to equity ratio decline over the period, low after-tax cost of debt, as well as strong equity growth. Interest cash coverage was also stable throughout the 5-year period. However, the company faces challenges in profitability and operational efficiency. This is shown by how inventory turnover slowed, collection and payment periods fluctuated, reflecting a slower inventory movement during years 2023 to 2024. Their profitability ratios, including gross, operating, and net margins, declined as well. Returns on assets and equity as well as earnings per share also fell, signaling reduced efficiency in using resources. In terms of market valuation ratios were volatile, peaking in 2021, followed by the decline in 2022 to 2023, and also a rebound in the year 2024. Cost of capital analysis shows a low cost of debt and a cost of equity near the weighted average cost of capital. However, the security market line analysis suggests that it is fairly valued, prioritizing on stability and lowering financial risk. So all in all, Greatech Technology Berhad remains financially stable with low financial risk, but declining in trend in terms of profitability and also limited short-term returns. So therefore, a whole recommendation, which is to wait and see, is appropriate and advisable for investors for future operational improvements or more attractive market conditions. And that will be the end of our presentation. Thank you.